Welcome back to The Deep Dive. We are your shortcut to what's really happening in the markets.
And today we are jumping straight into the Q3 2025 earnings for ISPO, the luxury travel company. The call was just on November 5th.
And our mission for you today is pretty critical. We need to unpack this massive disconnect between management, who sound incredibly confident,
and a market that seems, well, deeply skeptical about whether any of this is sustainable.
Exactly. So let's start with the headline figures. Give us the snapshot from after the bell on November 4th. What did everyone see first?
Okay, so the top line, it was a miss. Revenue came in at $55.5 million.
A miss by how much?
By about 7.5%, which is pretty significant. And it's a nearly 20% drop from the same quarter last year.
Oof. Okay, and earnings per share.
Also a slight miss. GAAP EPS was negative $0.36.
So a clear miss on the top line, which usually signals trouble. And yet the stock reaction was weirdly muted. It dropped at first, but then clawed some of it back during the call.
Right.
What was the narrative that stabilized things?
It was all about profitability. I mean, this is the whole story. They hit an adjusted EBITDA of negative $1.1 million.
So basically break even.
Basically break even. And that is a staggering 97% year-over-year improvement. They lost over $3 million in Q3 of 24. So this turnaround, even on sinking revenue, is why people stop selling.
A 97% improvement is, well, that's the bull case right there. But with revenue down 20%, you have to ask, are they just, starving the business to hit a number on a spreadsheet?
That's the key question. And look, it is a pure cost-cutting machine story. Management's whole focus was their four-pillar strategy, starting with just operational efficiency.
So where did the cuts come from?
Well, for starters, they identified $4 million in annualized savings just by going back and renegotiating hundreds of vendor contracts.
$4 million from just calling up vendors. That's some serious discipline. But is that, a one-time thing? You can't do that every year?
Probably not. But they went deeper. Q3 cash operating expenses, they were down by about $7 million year over year. Yeah, that's a 26% cut. So that's not just vendors. That's real organizational right-sizing. But you're right, there are trade-offs, especially in the travel segment itself.
Okay, so did we see that pain show up in their key travel metrics?
We did, and they'd say it was intentional. So occupancy in their properties, it slipped down to 56%. But their average daily rate, the ADR, jumped 20% year over year. It's up to over $1,700 a night.
Okay. So that's the pivot. They're going for fewer, but much higher paying customers, sacrificing volume for margin.
Exactly. They're chasing higher yield, better rev PR business. It's all about quality of revenue now.
And I'm guessing that operational story helped them fix the balance sheet. They raised some money, didn't they?
They did. They secured about $22 million in new financing right before the quarter ended. That shored up their liquidity, let them retire some old, expensive convertible notes.
You can't really get that kind of financing unless you can show that EBITDA improvement first, right?
Absolutely. You have to prove you can get to break even first. It's a prerequisite. And they also unlocked about $1.3 million in restricted cash after the quarter. It just shows that fixing the capital structure is a huge priority.
Okay, let's pivot to the future then. The core of their strategy is all about subscription revenue. This is where they're telling investors the big inflection point is.
And for the first time in a very long time, we finally saw some stabilization.
What did the number look like?
Subscription revenue was $19.4 million. Now, that's still down 16% from last year, but, and this is the important part, it was flat compared to last quarter.
And why is that so significant?
Because it stops the bleeding. It ends a trend of 10 straight quarters of sequential decline. For management, this is the inflection point they've been working toward.
And this is all being driven by the brand new Inspirato Pass, right? The redesigned product. This thing is now $40,000 a year. That's a lot of money.
It's a ton of money. It's a complete pivot to a super niche, super affluent customer. But that price point unlocks scarcity and, more importantly, much higher margins.
So what are the details on this new pass?
It launches January 1st. It focuses only on properties the company actually controls, so they're walking away from those low-margin hotel deals. And here's the key. They're capping membership at 2,500 people.
And where are they now?
They have about 1,100 pass members today.
So if they hit that 2,500 cap at $40,000 a pop,
you're looking at over $100 million in high-margin recurring revenue. That's a massive number for a company with this small market cap. And they said pre-sales since August have already beaten all of the past sales from the previous 12 months combined.
Wow. So demand is clearly there for this limited premium product.
It seems to be.
And that demand probably explains why the board walked away from that BuyerLink reverse merger and then turned down some other acquisition offers. They're betting the farm on this standalone strategy.
They are. They're essentially saying the value we can create ourselves with this high margin product is way bigger than any quick exit.
All right, let's talk investor context. They brought back their 2025 guidance. What are they telling the street to expect?
They tightened up the full year revenue guidance to between $235 and $240 million. And crucially, they're guiding for adjusted EBITDA to be positive for the year, somewhere between $2 and $4 million.
Okay, so they're promising positive annual profitability.
Yes, and they're projecting OpEx to be down about 15% year over year.
So the narrative is profitability. But the reality for investors is always cash flow. And year to date, free cash flow is still negative $10.3 million. The market sees that, right? The stock is still down 25% this year.
It all comes down to trust and validation. Management kept pointing out that free cash flow improved by $17 million year over year, and that Q4 is always their strongest cash flow quarter.
But the market's saying, show me.
Exactly. The stock price is telling you the market is waiting for sustained positive free cash flow, not just improving negative cash flow.
Yeah.
Q4 has to deliver.
And the execution risk just got dialed up. Their CFO, Michael Arthur, the guy who drove these cuts, is leaving at the end of next year.
Yeah.
That's a huge blow, isn't it? Losing the architect of the turnaround right in the middle of it.
It's a major red flag. I mean, it introduces a ton of execution risk right when they're trying to prove that this new, leaner cost structure is sustainable.
So if you're an investor, what are the, say, 3 key things you're watching for in the next few months to see if this story is real?
Number 1, Q4 cash flow. It's simple. Do they deliver the promised positive number?
Yeah.
2, the pass ramp. How fast do they get to that 2,500 member cap? And what does utilization look like? 3, the new CFO announcement. Who do they hire? Is it an operations person or someone else?
All right, let's move to our favorite segment. We're going to pitch an outrageous but plausible trade idea based on everything we've just talked about.
And the standard disclaimer applies. This is not financial advice. We're just running the numbers and connecting the dots here.
But if we were on the buy side, what's the pitch?
The thesis is what I'm calling the luxury scarcity arbitrage.
Okay, I'm intrigued.
We go long ISPO. And the argument is we value the company based only on the new pass product. Forget everything else.
Yeah.
Assume they hit that 2,500 member cap quickly.
Which gets you to that $100 million recurring revenue stream.
Exactly. $100 million in high margin, sticky subscription revenue. And with the balance sheet now cleaned up, that very specific, very profitable business makes them a super appealing tuck-in acquisition for a giant luxury platform.
Like a Marriott or an American Express, someone who wants access to that high-end customer base.
Precisely. The outrageous part is that the market is valuing the company like it's a distressed, dying travel agency, not like a high-growth, recurring revenue tech platform. We're betting someone comes in and buys them for a premium within 12 months, just for that past business alone.
And what's the catalyst that could make that happen?
Announcing a new CFO sooner rather than later, especially if it's someone with a heavy M&A or strategic transactions background, that would be a huge tell.
Okay, so to wrap it all up, management is making some genuinely tough, impressive operational moves. They got EBITDA to break even. They finally stabilized subscriptions.
But the market is skeptical. To win, they have to prove they can deliver positive free cash flow in Q4, and they have to nail this CFO transition.
The story is there, but the execution is everything.
And that leaves us with the final question you should be thinking about. It isn't whether they can cut costs. They've proven they can. The real question is whether $40,000 is the right price to attract enough of those high-value members to actually fund their long-term growth without just hitting the same old capacity problems all over again.
That is the tightrope they are walking into 2026. A fascinating deep dive. Thanks for joining us.